Last week, the Bank of America openly called for $40 silver and $4,000 gold. Once 40 becomes support, and once those stops are breached, it will become support, and the rally to close the $50 gap will commence. The bigger clues are all there. So while gold has been contained between 3,300 and 3,400, still is at the moment, silver has finally broken out.
Silver has entered a new phase of market strength, breaking decisively above key technical levels that had capped the metal for more than a decade. Analysts now identify June's breakout above $34 per ounce as a critical turning point, underpinned by a shift in institutional positioning and a visible reduction in speculative short activity. According to Andrew Maguire, a well-followed commentator on the precious metals market, this breakout confirmed that major market participants, including bullion banks, had begun covering large short positions. The subsequent move through $35 and $36 has converted historical resistance into confirmed support zones, with futures pricing showing signs of consolidation above $36. This structural realignment suggests that silver could be preparing to target higher ranges, with the $40 and $50 thresholds now re-entering strategic forecasts. Maguire emphasizes that what is now unfolding is not a transient rally, but a broader realignment in how silver is priced globally. The dislocation between synthetic pricing mechanisms and physical market demand has narrowed as deliverable contracts, particularly from non-Western exchanges, gain dominance. Liquidity providers are increasingly reassessing risk as short positions, many of which were tied to complex derivative structures and gold-silver ratio trades, are proving vulnerable to margin pressure. The gold-silver ratio, which had widened to levels as high as 120 to 1 in recent years, has now begun a measurable reversion. Strategic targets by institutional participants suggest a move toward a 35 to 1 ratio, which, if achieved with gold at current levels, would place silver near $100 per ounce. In this context, the global silver market is entering a structurally supported environment where shallow pullbacks are likely to be met with strong physical demand. As the influence of Western paper markets diminishes and BRICS-aligned exchanges assume a more prominent role in price discovery, the pricing mechanism is transitioning to one that reflects actual supply and demand conditions. With bullion banks no longer aggressively shorting silver and instead positioning long through physical holdings, analysts see upside momentum gaining credibility. Maguire points out that while tactical retracements may occur, silver is now positioned on a stair-step trajectory toward significantly higher valuations, with the $50 level increasingly viewed not as a speculative peak, but as an achievable benchmark within a shifting monetary landscape. Now, we present the clips from Andrew's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you and enjoy the video.
The banks have actually front-run the July season by a full month. Normally we see silver strong in July. So perhaps a quick look at the charts would actually be helpful at this stage. So just to make a note, this is being recorded on Wednesday. We've just had CPI, the CPI print, and so this will be released on Friday. So just be aware that that is the time we're recording this. It's really more important to look at the general direction and what we're expecting. And in fact, the very first sign that the bullion bank cartel was planning to short cover ahead of season was on the first trading day of June, which was here, where spot silver took out the next round number. If you remember, we've been consolidating. When we were talking about, in our last episode, we were talking about the 33 spot level. These are futures charts, so there is slight adjustments because of the contango between futures and spot. But essentially, on the first day of June, suddenly we blew through, or silver blew through, the 34 spot level, which is approximately $34.08 in futures. And not only did it blow through, and it immediately has now become support. So I didn't even get down to testing it before it was front run. Normally we see a pullback, So essentially that is where we first saw the rally. Then once again, now last Thursday was interesting. This is really when silver's mispriced 14-year underperformance breached large resistance at $35. We saw the $35, which is right here, and actually hard testing and really triggering short stops at $36. Now the contango expands a little to 12 cents at that price, and it will in fact expands a little bit more to 14 cents when we get up towards 37. But essentially, this is what we were looking at. And this has created a historic inflection point. And guess who was on the short side? It was actually the siloed speculators here and here that got royally rinsed. And what we've evidenced is really this inflection point. We're talking about the cartel having repatriated sufficient bullion. Collectively, they've allowed silver to decisively break out of a 14-year capped range. And so really, when you think about it, we're now dealing with a 14-year cap range. In fact, on Thursday, silver futures went bid only, forcing a massive short squeeze upon sleeping specs who'd become acclimatized to selling billions of dollars of bets against silver rising out of this 14-year capped range. Now, as we know, and we've done in episodes about this before, it's the highly leveraged options traders that get carried out feet first, because when the leveraged cash bets they have made against whatever the asset class is, but in this case it's billions of dollars of paper bets against physical silver, and once they're called in, it happens all at once, and the market can suddenly go bid only, and losses to buy back these naked short bets can far exceed enough cash reserves to close these bets. In other words, it can bankrupt the short seller. Most people think of options as buying options. Now we're talking about aggressive selling options at the top of a sequential range in the hope that it will come back down, and it has worked well for them. But when it goes bid only, look at what happens. Now we're in the process of seeing the first two signs of going bid only. Now, given there are several naked short CTA structures, commodity trading advisor structures still vulnerable for margin calls, liquidity providers are betting we may see some further bid only setups developing. Now, while these speculator bets are little more than collateral damage around what is really a multi-year Fed-held OCC FX bets against silver, and we talked about the OCC FX bets, which are largely in the Fed's hands, and they can obviously, because the Fed's controlling them, they can be cash settled by way of a series of keystroke entries, much as we saw when that happened after the Shanghai Futures Exchange caught the short sellers wrong-footed, and really then we saw this sequential series of higher stair steps devolve.
Recent developments in the precious metals market signal a significant shift as bullion banks quietly accumulate silver in their accounts, indicating confidence in a strong rally ahead. After years of a steady 14-year silver cycle, this trend now appears to be breaking down, with speculator interest thinning out and banks stepping in to take more prominent positions. Last week, Bank of America made headlines by openly forecasting silver prices could soar to $40 per ounce, alongside gold reaching $4,000. This prediction surprised many, but echoed the advisory stance of Goldman Sachs, which has reportedly encouraged clients to hold long silver positions since April. Andrew Maguire confirms that this buildup is part of a deliberate strategy to trigger a significant short squeeze, potentially driving silver prices well past $40 toward $50, supported by rising physical demand and constrained supply. Meanwhile, gold remains steady between $3,300 and $3,400, showing signs of strength despite ongoing market fluctuations. According to Andrew Maguire, institutional buyers in Asia have adjusted their approach, opting to buy later in trading sessions to mitigate Western selling pressure. This shift is pushing gold support levels higher and paving the way for a potential breakout beyond the $4,000 mark. Amid regulatory discussions surrounding Basel III compliance, Maguire points out that allocated physical gold held by central banks and major institutions meets all necessary standards, providing a foundation for market stability. The continued focus on unallocated gold, often highlighted in speculative debates, overlooks the true liquidity and physical backing supporting the market. With bullion banks cautiously positioned and physical demand rising, Andrew Maguire stresses that both gold and silver are poised for meaningful rallies that investors should closely monitor in the coming months.
Last week, the Bank of America openly called for $40 silver and $4,000 gold. And nothing new in that about gold. But silver surprised a lot of people. And funnily enough, their advisory, by no coincidence, jived with Goldman Sachs, aggressively talking up their long house account silver book, and that is house account. And as we've been reporting by way of our Goldman Sachs liquidity provider for some time, the in-house Goldman Sachs advisory for their clients to get long silver has actually been in place since April. I don't see any surprises here. However, last week's public advisory, that is, ahead of non-farm payrolls, which is most unusual to see a move before a non-farm payrolls, which of course they would have had the data of ahead of time. But it not only spilled the beans on, quote, staying long silver, as they put it, but also advised holding fire on adding longs until the bid-only short squeeze played out in full. And then they said to action, quote, significant spot and futures long additions should be initiated. Now, our close contact, Goldman Sachs liquidity provider, figures this advisory to instigate fresh silver positions will be announced when silver tests $40, which clearly indicates they expect a gap close to $50, which will quickly follow. Obviously, along the way, we expect the cartel to also rinse out any fresh spec longs they can, but with the unallocated to physical lines actually now crossed, collectively, there's far more to be gained to see silver above $50. So dips from here on are going to be bought. And obviously, that is something that is going to offer opportunities. So bullion bank targets of $40 look compelling. However, tagging $40 will spill blood in the water, attracting momentum-fueled sharks who will undoubtedly want to test for buy stops above all-time highs before seeking to ring any kind of register. And as we've evidenced at every spot round number being taken out, pullbacks to these round numbers have become bricks-centric supports. And once 40 becomes support, and once those stops are breached, it will become support. And the rally to close the $50 gap will commence. The bigger clues are all there. So while gold has been contained between 3,300 and 3,400, still is at the moment, silver has finally broken out of, and it's been tripping off very large official shorts related to the gold-silver ratio trade. And while currently contained at and below the 36 level, the odds of targeting the next layer of short stops at $38, which we talked about last episode, opens up a path to $40 sooner than the market is actually currently structured for. So really, in summary, while the unwind of the ratio trade is short-term weighing on gold, Asia is buying, and higher stair steps are being anchored in both. Following the bullion bank advisories, silver open interest, the silver futures open interest, which is easy to track, has ramped up significantly, as you can see here, with the CME physical silver cover also ramping up into a race to repatriate. Now, we're recording this episode on Wednesday the 11th, and as of yesterday's data, the 4-week change in the SLV ETF exchange evidences an inflow of over 690 tons, with actual total net inflows with all of the various ETFs, etc., at 1,073 tons. That's the 4-week change. That's a 4-week bullish change. Now, whereas gold open interest has stayed muted evidencing the gold silver unwind. The short squeeze is underway. So gold is coiling for an end of second quarter rally.
All right, Andrew. And again, the majority of our questions this week were all about silver. So thank you so much. And I'm sure we've answered a lot of questions with that answer. Now, Andrew, what are you seeing now in gold moving forward?
Right. So medium and longer term. I mean, look, ignore the chart chatter. We had CPI today. It shot up. It came back down. I mean, basically the algos are at work. So ignore the short-term chart chatter. We're looking medium, long-term. Gold continues to coil extremely bullishly for a very strong end-of-year close. Now, while very short-term feedback from our physical-facing liquidity providers indicates that while the banks lean into this unwind of the ratio trade, commercial is exposed to a growing wall of still undelivered T+1 delivery obligations will be short covering at and below any dip into 3,300. That is, we've been witnessing that for some time. And note that pretty much all the last 10 or 12 fixes have been above 3,300. So there might have been dips below, but this is all game stuff. They don't really want to deliver central bank size into where these orders are, at the fixes, that is. Now, given the consistent Western capping attempts, as we outlined last time, we had pointed out China's change in strategy from the immediate of buying Western end of session dips. So the West sells at the end of the day, and then Asia, we used to be quick to buy it. And we talked about this strategy change last time, where they reverted to employing late buying, allowing the West to continue to, and obviously we're talking about, there's two different categories here. There's speculators will come in and buy straight away. But we're talking about the institutional money, the pension fund money, the central bank money, sovereign sized money. What they're doing is waiting until later in the session. And so to capitalize on these dips, and reverted to employing into, then what they would do is, then you'd see suddenly a well-attended AM fix. So that was their strategy. We outlined it last time. Now we continue to evidence this. However, once 3,500 gold is breached for a fix, we expect Chinese traders to front run a race to 4,000. Now we saw it when the Shanghai Futures Exchange launched. We saw the relentless buying, momentum driven, but long enough at each stage to bring the physical level, the support levels higher. That's how stair steps are formed. And when we look at the COMEX data for gold, the distinct lack, you see it, of long Western market participation is incredibly bullish, as it limits the sell ignition triggers. In other words, bid pull, try and target some stops, long stops, create this sell ignition. Everyone races to get out. It makes it very difficult. So therefore, the dips are shallow.
Many analysts and investors anticipate a strong upward movement in precious metal prices as global demand intensifies and supply struggles to keep pace. Silver is expected to lead this rally due to its critical role in emerging technologies such as renewable energy, electric vehicles, and advanced electronics, where shortages of physical metal have become increasingly evident. This tightening supply, combined with rising industrial and investment demand, could push silver prices well beyond previous peaks, attracting increased interest from both speculative traders and institutional buyers seeking to capitalize on the momentum. At the same time, gold remains a reliable safe haven amid persistent inflation concerns, geopolitical instability, and economic uncertainty. The convergence of these factors suggests that precious metals will maintain strong price momentum, making them key assets for hedging risks and preserving value in an unpredictable global financial landscape. Where do you think silver prices will go next? Share your thoughts in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the next video. Thanks for watching.